It's difficult to make predictions, especially about the future. This video is for educational purposes only and should not be considered financial advice. Please do your own research and consult with a financial advisor before making any investment decisions. So today I'd like to talk about my cash flow chart and how it plays into my investment strategy. And just kind of walk you through what looks like a complicated cash flow, but it's not all that difficult once you kind of break it down into segments. Invest through options. Sell long-dated, out-of-the-money options against shares of dividend-paying stocks. Scale into your investments using charts, stock analysis, and return on investment calculations, along with a divergent trade setup for entry. Risk no more than 2% per trade. Exit trades systematically with a buy-to-close scale. If put, work to reduce the cost per share from dividends and call premium. The goal is 0 cost per share. By selling options, you allow 2/3 of the potential market movement to be in your favor. Here's how. This is not a leverage strategy. I do have an actual cash pool. Because of my cash pool, I receive interest on my cash, giving me a floor of 5% return on my money. So anything that I do has to return greater than 5% annualized return for me to risk my cash. When I do, this is how I do it. The cash that's in my cash pool will be securing, I call it cash escrow just because I'm from real estate, so escrow makes sense to me, but it will be removed from my cash pool and goes into escrow when I sell to open a put option. The buyer of the put option will pay me a premium, which will flow back into my cash. The securing asset will flow out and be escrowed until the transaction is closed or I am put the shares. Here's an actual example of how that looks from a $1,000 perspective. We have $1,000 in our account. One option contract represents 100 shares of the underlying stock. One put at $10 equals 100 shares times $10 equals $1,000. We are receiving $100 in premium. If buy to close, meaning that I purchase this contract back, equals $100 premium minus the $25 it cost me to close said contract, leaving me $75, and the return of my $1,000 investment would give me a return on investment of 7.5%. That 7.5% return if closed in 160 days, which equals 17.1% annualized return. I'm not receiving 17.1%, but I would be receiving 7.5% in less than half of a year. Here's how that transaction looks. Sold to open, one put January 19th at $10, escrowed $1,000, so my $1,000 has now gone into escrow. $100 of premium has come from the buyer of the put, so it has flowed through this option contract back into my account. My account now only shows $100 because the $1,000 has been escrowed. When I initiate a transaction to buy to close the contract, we buy to close one put January 19th at $10. It cost me $25 in premium returned equals $75, and my $1,000 back into my account is a 7.5% return on my investment. I invested $1,000. I kept $75 of the $100. I now have $1,075 in my account. The $25 has gone back out of my account through the option contract and is paying the buyer of the put back $25 out of the $100. I retained $75 in this transaction, giving me a return of 7.5% in 160 days on the market. cash went into escrow. The buyer of the put premium came into cash, purchased the contract back. Some small percent went back to the buyer of the put. My escrowed cash came back into my pool and then began collecting an additional 5% from that point on. In the next video, I'll discuss what happens if I'm put the shares. This execution of being put the shares occurs approximately 25% of the times that I initiate a sell to open contract. Thank you for watching. Please leave any comments below and let me know if there's anything that you have questions about or would like to see additional videos on. Trade well, my friends.